Hello there, I'm Oliver. We are going to take a look at ways to avoid paying capital gains taxes on a rental property. This is not legal advice, and depending on where you live in the world, certain laws may or may not apply to you. So let's get started. Capital gains tax is imposed when you sell assets, for instance, rentals for profit. However, you could be able to get them out of the way in certain situations. Real investment in real estate is a popular method to make money. However, if you buy rental properties and sell them for profit, you might be liable to the IRS some of the amount you earned. Taxes that are imposed on the gains from real estate are known as capital gains taxes, and they operate differently from conventional income taxes. Property owners might also be able to dodge the tax. This video will help you be aware of to avoid having to pay taxes on capital gains earned from renting properties. So what are the capital gains tax implications? If you're thinking about whether to make investments in real property, it is important to keep tax-related liabilities in your mind. The IRS will take a cut of every dollar earned within the U.S. Taxes are assessed when you earn income from work, for instance. You're also taxed when assets that you own rise in value and you are able to sell them for profit. Assets you hold to use for investment or personal reasons are known as capital assets. If you sell them at a greater price than what you purchased them for, then you will experience capital gains and could be required to pay taxes on the gain. The gain from appreciation of capital assets doesn't get taxed at exactly the same rates as earnings, however. Instead, it's subject to taxes on capital gains. There are two kinds of capital gains taxes that you must be aware of when you are learning the best way to put your money in real estate or other investments. Short-term and long-term capital gains that are short-term, and are taxed according to your normal income rate based on your bracket of taxation, as well as capital gains that are long-term in nature. Capital gains that are long-term are taxed at a lower rate as the government wants to encourage responsible investment behavior, such as purchasing and holding. Now, what is the process for capital gains on investment properties function? Capital assets are investment properties similar to other investments you make in, like stocks. If you sell them for the price of profit, you'll be taxed on capital gains. To determine if you're making a profit selling your property and the amount of tax-deductible amount you earned, first you must be aware of the asset basis, also known as the cost basis. These are tax terms that describe the price that the house has. Most people will say that the cost basis or asset basis is the sum which you paid to purchase the house, plus the transaction cost and the costs of any major renovations. It includes the entire amount spent to purchase it, which includes any loan you took out to finance your purchase along with the commissions and fees that you paid in connection to your purchase. Also, it includes the expenditures to boost the value of your home for sale, like installing the roof, or upgrading the kitchen. If you did inherit the investment property or it was given to you, there could have been the possibility of an adjusted base. In this scenario, the value at which you started the property used in calculating the gains can be calculated in various methods, including its fair market value as of time of the gift. It is also important to know the net proceeds of the sale of your property. It's the sum you make after accounting for commissions as well as other expenses. Once you've established the cost basis as well as net proceeds, you'll be able to determine the percentage of your earnings are subject to capital gains tax. As an example, suppose you paid $360,000 for an investment property, which includes closing costs as well as the initial transaction costs, and you invested $50,000 in upgrading the property. Then, you sold it at $450,000 and paid expenses of $5,000. Here's how you can figure out the amount you'd be required to pay tax on. $450,000 sales price. Initial purchase of $360,000 price, which includes transaction costs. $50,000 in significant improvements expenses. $5,000 transaction expenses. That means the total profit comes to a total of $35,000. So, you'd have to pay capital gains taxes on the net profits of $35,000. If you held the home for longer than a year, then you are taxed on this $35,000 at your capital gains rate, which could be 0%, 15% or 20%, based upon your earnings. If the property was owned for shorter periods, you'd be taxed on the profits at the normal tax rate on income. If your adjusted gross income is greater than $250,000 for married couples filing jointly, $125,000 for married separately filers, and the $250,000 limit to qualified widow-ers with dependent children, or $200,000 for taxpayers of all other types. You could be taxed at an 3.8% net investment tax on income. This is regardless of whether the gains are short-term or long-term. Strategies to minimize capital gains from rental properties. As you will see, capital gains may be a significant influence on the amount of money you earn. However, there are ways to not pay capital gains tax for rental properties. Here are some alternatives. Gains and losses offset. You can take advantage of capital losses to lower capital gains tax. Capital losses are in the event that you decide to sell an item for the loss. For instance, if buy stock at $100, but it loses value and you decide to sell shares for $75, you've suffered an expense of $25. The ability to utilize the losses you have suffered to compensate for gains when you recognize the losses or suffer them. If your stock declined in value, say it would be difficult to claim the loss even as long as you held the shares. Therefore, you might decide that you'd prefer to be careful in the sale of loss-making assets. If you're sure you're likely to earn big gains on one particular property in a particular tax year, then you might be tempted to sell your assets in the same tax year, if you're certain that there won't be a rebound, to take the losses to offset gains. This is known as tax loss harvesting. Losses from capital investments can be offset by an infinite quantity of capital gains. For example, if you earn $35,000 and lose $40,000, you won't be required the burden of paying capital gain tax on the profits of $35,000. If your losses are greater than the gains you earn, you may also be able to deduct up to $3,000 a year of loss on capital from normal tax-deductible income if you're married joint filers. This amount decreases to $1,500 for tax filers who are solely filing or married filers who are separate. You may also transfer capital losses to the next year in case you are suffering from a large amount of losses. Exchange 1031 form. There is also the possibility to save capital gains tax if you perform an 1031 exchange. The section is located in Section 1031 in the Tax Code of the United States. The 1031 exchange is in the event that you use the proceeds of the sale to purchase another property, which is also known as essential to follow certain guidelines and ensure that you are making a like-kind property exchange, meaning that the property should be comparable in terms of its nature and style to the property that you sold. The replacement property. You can purchase a rental property that is similar, or more to meet this requirement. There is also a short period of time to buy a second property using the proceeds of the sale of the one you currently own. Particularly, you have to identify another property you wish to buy within 45 days and complete the purchase within the first 180 days after the sale of your home or by the tax due date, including extension, in the calendar year that you sold the house. Also, you can't have directly control of the proceeds from the sale between the sale and when the property purchased. The use of an intermediary, such as an escrow firm, could assist you in avoiding getting into problems with this part of the procedure. Convert your rental into your primary residence. Principal residences have distinct tax rules for capital gains as well as home sales tax regulations as opposed to rental property. However, you must meet certain requirements for you to transform a rental home into an actual primary residence. Particularly, you have to have the property as your primary residence for at minimum 2 of 5 consecutive years preceding the date of sale. If you used depreciation as a tax deduction while operating this property for rental before changing it to the primary residence, you'll need to recover the depreciation deduction and pay an annual tax of 25% on it. If, for instance, you took a depreciation deduction of $5,000 while using it as an investment property, you'd be required to pay a tax on depreciation equivalent to 25% of that amount, which is $1,250. If you meet the criteria to convert your rental property into the primary residence prior to selling it, you're permitted to exclude up to $250,000 of gains if you are filing as a single taxpayer, as well as up to $500,000 gains in the case of a married joint tax return filing. These exemptions apply to any primary residence. That means that you will not have to be liable for capital gains tax on these gains. But, you can't benefit from this exemption if you had a different home in the 2 years before you sold the particular property. Purchase properties using your retirement account. If you have the assets of a qualified retirement account like an 401k, traditional IRA or Roth IRA, in which case, you may defer tax payment in the event that you sell the assets within the account for an income. It is only possible to make real estate investments through retirement accounts when the account is self-directed. The majority of retirement accounts for individuals and employers accounts that are a part of standard brokerage firms aren't self-directed and aren't able to make real property investments. Some financial companies allow self-directed accounts, which you can use to purchase any asset you want, such as real property. Also, you must keep an arm's length distance from the investment, meaning your relatives or close ones cannot live in the home and actively oversee it. Any proceeds generated from the property should also be returned to your retirement savings account. Frequently asked questions.
Can you dispose of a rental property without paying capital gains taxes? Is it possible to rent properties without having to pay capital gain on profits?
It is possible to do this, selling investment losses and compensating your gains with the capital losses resulting from it. A 1031 exchange is the process of using the proceeds of your sale to buy another investment property of the same type for 180 days. Converting the rental property into an actual residence by owning and living there during 2 out of 5 prior years to it is sold, you may benefit from an exclusion of as much as $250,000 or $500,000 in gains, depending whether you're married or a joint taxpayer. Making use of a self-directed retirement plan to fund your real property investment.
What is the method by which capital gains tax calculated for the disposal of rental properties?
Tax on capital gains is on net proceeds less costs basis for the home. Net proceeds refers to the price of sale after transaction expenses and minus costs basis. In the majority of instances, is the purchase price at the beginning of the property as well as the transaction cost and any funds spent on major improvements. If the property was given to someone else or acquired by inheritance, and the cost basis might differ. In the event that the home was used for less than a year, then the owner is liable to pay short-term capital gains, and be taxed at their normal tax rate on income. If the property was owned for longer than 1 year, the owner is required to pay capital gains taxes for long-term capital gains. They are taxed at 0%, 15%, and 20% based on their income.
How long do you need to remain in a property that you rent in order to get rid of capital gains tax?
You are able to avoid capital gains tax on upwards of $250,000 in gains for tax filers who are single, or $500,000 when married couples file jointly, if you are able to convert a rental home into an actual residence and fulfill the conditions for exclusion of gains. You must have owned and used this property for your principal residence for at least twice in the 5 years prior to the sale to be eligible of the tax exemption on capital gains. Bottom line, capital gains tax is a way to be a significant portion of your profits if an experienced real property investor. However, as you will see, there are a lot of methods to cut down on your tax burden in the event that your property grows in value. The most efficient tax software or a seasoned tax professional in real estate can assist you in understanding your tax saving options. Thanks for watching.